Morning, guys. Can you hear me okay? Great. So it looks like we've got a small group today. I didn't get many trades or trade plans or ideas through from you all. So what I'm going to do is just postpone that webinar until next week when we've got more to work with, so that it's really kind of worth your while. And instead, I'm going to move on to navigating scale. Okay. So I hope you're kind of starting to get to grips with what we've covered so far: flag limits, market structure, FTRs, the kind of liquidity dynamics I'm looking for on approach, and how to identify liquidity or lack thereof on a chart. But this webinar is probably one of the most important, because today we're gonna kind of put all of that into context. And I've called it Navigating Scale, Trading Flow and Managing Expectations, because I'll mainly be talking about scale, by which I basically mean time frame. And of course, time frames are simply a zooming function of the same data. You're just seeing the way in which price traded or is trading through a series of prices in more or less detail. Okay, but one of the main issues I see crop up is that people are unsure about how the kind of liquidity dynamics I'm talking about and have been talking about kind of interact with structure across or between different time frames. And it's a totally valid concern, because it's easy to get confused about terms like trend and shit like flag limits and FTRs when price looks different depending on what time frame you're looking at. So yeah, today I'm gonna just break down some general thoughts and more kind of practical approaches in regards to timeframes and how to manage trades. So where to take profit and all the rest of it. In other words, how to form an expectation for price based on scale. Okay, and as usual, feel free to interrupt me if you've got a question. So when it comes to scale, I think it's quite important that you have a good understanding of first just why it matters. So a large part of what I'm going to cover today will be kind of theoretical. So I hope that's okay. And just let me know at any point if it gets too dry. Okay, let's get on with it. So the first point I want to make is that price is fractal. Okay, you've probably noticed by now that this is a Romanesco cauliflower. Much like the cauliflower, price appears similar at all levels of magnification, such that if I showed you a chart kind of devoid of context, you probably wouldn't be able to tell me what time frame I was showing you. So the same dynamics which are occurring on the hourly chart, they're also playing out on every other time frame, right down to a tick chart. So there are structures within structures, and the same patterns repeat over and over on all time frames. So in this sense, price is self-similar, okay, which means that basically, a price swing on the lower time frames will often have the same or similar shape or characteristics as price viewed on any other time frame. Okay, and this self similarity appears on all scales. So a swing which appears over a long period of time Okay, just very basically, let's say a daily chart is of course made up of hundreds of smaller swings. Okay, so within this price leg here, you might have a very similar kind of structure. The way in which price moves is similar on, let's say, the M15 or the hourly as price on the daily, and then within this again, each of these legs will have similar characteristics. Price moves in a similar way on let's say the minute chart or the M5. But if you examine these swings, no matter how small, even on a tick chart, the point is you'll always see the same types of structures, each of which is a facsimile of the whole. Okay, so it looks similar to other time frames basically. And I think I might have showed you this before, but this gold chart is a really nice example of this. So I think this is an M5 chart, and you can quite clearly see the flag limit up here. Okay, you've got this thin or liquid move, pause or consolidation, price flags out, consolidates on top of this structure here. Okay, so that's the liquidity which is holding up or supporting this flag. And of course, when it breaks down, when that liquidity gets consumed, price comes down and it fills in this illiquid leg in price. But if I zoom in on this structure on an even lower time frame, okay, this is the M1 chart. I think the same structure appears again up in here. Okay, relatively illiquid move. Okay, price pauses before flagging out on top of that structure until it consumes the liquidity there, consumes the residual liquidity, and comes back down and fills in this illiquid move. Okay, so the same structure which is appearing on the higher time frame, in this case the M5, okay, flag limit, flag, is also appearing on the M1. Okay, so in this sense, price is self-similar. Okay, and if I were to, I don't have a chart, but if I were to zoom in on this section of price action up in here, you likely find the same thing again. Okay, you can just about make out this illiquid move here, tiny pocket of liquidity there, above which price kind of consolidates before eventually breaking down. Okay, so that's what I mean when I say price is fractal. And of course, all of these dynamics are tradable, but I guess the question is, which ones should you be trading and where? Because you might be asking, well, if price is fractal and if the order flow dynamics are the same on every time frame, why pay any attention to the higher time frames when you can kind of maximize your opportunity trading on the M1, or even a tick chart? And there are a few reasons you can't just trade every price swing, regardless of time frame. The first couple of which are just practical. For example, this might seem obvious, but of course, trades just take longer to play out on the higher time frames. This means that you have longer to plan your trades and more time to kind of assess price and consider how you manage a trade once you're in. So for some of you that might be important, and as a result, you might be less likely to overtrade, for example, which is important because if you don't have a very intimate knowledge of your own psychology and a strict set of criteria for limiting losses, it's easy to end up in a period of extremely nasty drawdown by trading on the lower time frames. Another kind of practical reason is that trading costs quickly add up and can become quite overwhelming and erode your edge on the lower time frames. So just for example, let's say you're trading on the M1, okay? You enter here with a $10 stop loss and a $100 target, okay? Your theoretical risk to reward ratio is the same as if you are trading on the H4 or the H1 with, let's say you enter here and you have a $100 stop loss and a $1,000 target, okay? The risk reward is the same. The difference is that the impact of spread and slippage is much higher when your stop is this tight, especially if you're trading with size. Okay, so if you've got a stop loss of $10 here, if you get slipped, let's say $5, you're increasing your risk by 50%. And if you're entering a market, let's say the spread's quite wide, let's say $3 or $4, you're increasing your risk quite dramatically. Whereas the spread and slippage don't really impact your risk reward if you're trading on the high time frames with a wider stop. Does that make sense? So the practical aspects of executing trades can really kill your edge on the lower time frame. So that's just something to keep track of. Anyway, that's quite basic stuff and not really the point of this webinar, but I just thought I'd mention it. But the main reasons why it pays to pay attention to and kind of trade around high time frame levels is that levels on the higher time frames are simply more significant than levels derived from the lower time frames. You have to be starting your analysis on the high time frames and then working your way down, because context really is everything, and I'll explain why in a minute. High time frame levels are more significant, but first I just want to make it clear that if you try and trade the kind of stuff I've been teaching without a good grasp of scale, you're probably going to struggle, okay? Because when a market turns based on higher time frame levels, what you'll find is that price will just blow through levels derived from the lower time frames. So you always need to keep the big picture in mind. Because levels in the lower time frames just aren't going to hold. They're not going to work out like you want or expect them to when you're trading against the higher time frames. And the last thing you want to be doing as a trader is getting in the way of high time frame flows. So start from the top down. Make sure that you're not starting your analysis on the time frame on which you're executing or placing your trades, because it creates a very narrow and kind of one-dimensional view of the market, and it will no doubt leave you feeling extremely frustrated. Anyway, I'm going to come on to how you might go about doing that in a minute. But you may have heard or read people give advice like trade the trend, or the trend is your friend. But one of the issues with cliches like this is, of course, that price only quote unquote trends on a relative scale. So let's take this. This is a weekly chart of the USD Canadian dollar. Long term, it appears to be trending up. Okay, price is moving from the lower left hand side of the screen to the upper right hand side of the screen. But within that, you've got what looks like a kind of a shallow downtrend up here. And then within that again, okay, price appears to be trending up, okay. Higher highs, higher lows. You've even got a couple of trend lines here. You can mark that out with. Okay, but if I zoom in again on this section of price action on the daily, okay, here we are on the H4. You can see that even within this broad uptrend on the lower time frames, there are large periods of time where price appears to be trending down. Okay. So, where the fuck is the trend? And if I zoom in again on this section of price action, just to make the point clear, it gets even more confusing. You've got what appear to be multiple trends even in this small section of price action, including periods where price appears to be just kind of constrained in a range, which themselves are of course just series of trends on even lower time frames. So the question is, which trend are you trading? Because before you take a trade, you have to be aware of the scale in which you're working, because this is what should define your expectations for price. An understanding of scale should determine what trade you take or don't take, but also where you take profit and how you manage the trade. Anyway, I hope I haven't confused you too much there, but by the end of the webinar, you should have a good idea of what I'm talking about here. Any questions so far before I get into some theory? Or are you all good? Alex is asking, so lower time frames are not more noisy, random than higher time frames? There is more noise on the lower time frames, yes. Hang on. Yeah, lower time frames do tend to be more noisy, and I'll explain why in a minute. But often, I think a lot of the confusion when trading on the lower time frames isn't as a result of noise; it's a result of you not understanding the bigger picture. Okay. So I hope you don't find this too dry, but yeah, as I said, I want to start by going over some theory so that you have a really good understanding of why I think scale is so important. And it all comes down to what's called long memory and order flow. Long memory and order flow, by which I mean flow, basically. Buy orders following buy orders and sell orders following sell orders. And there are two main schools of thought on why the markets demonstrate long memory and order flow. The first is that traders display what's called herding behavior, like these sheep, either because they all respond similarly to common information, and that's a process which happens over a period of time, either because different traders have different response times, or because information is distributed asymmetrically. So because not everyone gets information at the same time, or because traders observe the behavior of other traders and change their strategy accordingly. So, in this sense, they're responding to private information that other traders have indirectly. Okay, so the idea here is that information is conveyed in price action, and so traders will monitor each other's actions through technical analysis, what we're doing here, of volume and price action, and will update their strategies to imitate those of others. So effectively buying when others buy and selling when others sell. And so if herding is the mechanism or part of the mechanism which explains long memory and order flow, then it makes sense that the higher time frame levels or structures are more significant, or will be more significant, as they're simply more visible to more people. Okay, daily level is clearly more apparent than one derived from the M1 chart, and so the idea is that more people are reacting or trading in response to that level. However, from the literature and from what I understand, it seems quite likely that herding, this explanation only has a small part to play in the long memory of order flow. The second, and I think the best explanation, is down to something referred to as order splitting. So some of you might have heard of this or be aware of this, but this is the idea. Most markets are, in fact, highly illiquid. Even some FX markets, and especially these altcoins some of you trade. So if an institution or very large trader has a big order to fill, they're basically forced to split their order up into smaller chunks. Okay, so I couldn't just market buy $100 million worth of Bitcoin all at once on BitMEX without getting a really shitty entry, as a result of the fact that an order that size would have a significant impact on price. I'd get slipped. I also can't stick a limit order in the book, because that would reveal valuable information, i.e., the presence of demand. Okay, and so the assumption here is also that larger traders are on average more kind of informed, and so my order would probably get front run, again pushing price up and either resulting in an incomplete fill or giving me a shitty entry. And of course that's not what you want. So yeah, large traders and institutions have to kind of filter money in and out of the market in small chunks, basically kind of spreading the execution of their orders out over long periods of time. And if you want to read up on this, then the most kind of comprehensive paper and most easily digestible paper is this one here: How Markets Slowly Digest Changes in Supply and Demand. And you can find a copy of that on my website. But the point is that large trades have to be split up or fragmented. So a large or quote unquote informed trader needs time to build a position. They have to scale in and out by necessity, and so they trade incrementally. Does that make sense? Because the outstanding liquidity in any given market is usually relatively low, it's latent. trading for big players is inherently an incremental process. And as a result, and this is really important, large traders or institutions tend to trade in the direction of long-term fundamentals. And that's really the reason why you could think of the higher time frames as being kind of quote unquote controlled or shaped by participants with a long-term outlook on the market. It's because these participants are the main source of large latent supply and demand, and play a really big part in the long memory of order flow. Is everyone following? Okay. As I say, just let me know if you want me to clear anything up. So, just for example here, in a range like this one here, or this one here, this is Euro GBP on the daily, by the way, but it could be any pair on any time frame. In ranges like these, within which, of course, there are all kinds of dynamics going on the lower time frames. Within these ranges, higher time frame traders are slowly absorbing supply in anticipation of a big move, and most of them will be using execution algorithms to kind of bleed their orders into the market bit by bit, using something like VWAP or some other metric or performance measure, basically buying as low as they can and without pushing the market up. But inevitably what happens is that the liquidity on the top side of these ranges, the sellers, those sellers are going to run dry, and price will drift up and away from these levels, so it will break out. And when price does break out, like it does here, okay, some of these long-term traders will no doubt become more aggressive, by which I mean they'll start buying at market. And this is a very simplistic explanation, but basically everyone has different parameters. They're all trading on different scales, different time horizons. So some of these large traders will start buying at market because they want their order completed for whatever reason. There's a sense of urgency, while other more patient traders or institutions are, they'll be content to sit down at these levels and basically wait for price to retrace. Okay, so it's these more voluminous areas. It's these levels at which you want to pay attention. Okay, so here I've got a I think this is a monthly chart, same chart but on the monthly. And these are the two areas we just looked at on the daily. Okay, so the idea is that you want to be paying attention to liquidity bases like this, which appear on the higher time frames, because these are the areas in which large players are doing business. And bear in mind that although I'm demonstrating this on the monthly here, just to kind of emphasize the importance of taking a top-down approach, price is fractal, and so these kind of relationships play out in all time frames. So, normally I won't be looking at a monthly chart, but the same dynamics are going to play out on the daily, on the hourly, even on the M5. And again, the idea here is just that we can expect large unfilled orders here. There are big orders waiting to be filled at these levels, and so they'll react time and time again over time spans which can be days or weeks or even months long. Is that all clear so far? So, you know, you'll all find your own way of charting and trading determined, I guess, largely by what kind of trader you are and how much time you have to trade. And you know, what style of trading kind of suits your personality or your own personal psychology. But however you end up structuring your analysis, it's always important to have a good idea of what's going on in the higher time frames. And of course, you know, what constitutes a higher time frame will vary between traders. If you trade on the M1, you might consider the hourly a relatively high time frame, and if you trade on the hourly, then you'll want to be aware of where those big levels are on the daily or weekly charts. But the point is that even if you're trading primarily on the lower time frames, it's really important to know where you are in relation to the big picture. The reason being that you know, if you're down at a level like this on the lower time frames, you can start expecting a reversal. And as I say, I'm not usually trading off a monthly chart, but I'm just going to use this to demonstrate, because it's actually quite a nice example of how you might want to structure analysis. So let's take this liquidity base here. Okay. At this point, it's fresh. Okay. Price comes into it relatively quickly. Okay. On the monthly, this is what we call an illiquid move. And you know, it's the same dynamic playing out again and again on all time frames. We've got the presence of liquidity and what looks like a relatively thin or weak move into the level. Okay, so on the lower time frames, when we're down here, I'm expecting sellers to start getting taken out. Okay, for buys to kind of take control, and for those lower time frame highs to start getting broken. So if we go down to the weekly chart, again, this is the area we're looking at. Okay, this is that move which looked you know, thin on the monthly chart, and lo and behold, on the weekly, the highs start getting taken out. There's your breaking market structure, and so at this point, I'm thinking it's time to start buying pullbacks. Okay, we're down at the monthly level. On the weekly, price has broken market structure. Okay, that's kind of confirmed to me that yes, there are buyers here, and yes, sellers are starting to get weak. But remember that once price has broken structure, you're not buying a pullback into the nearest kind of hourly level, right? That would be what I call banking on the immediacy of a move. So perhaps if price is moving into an extremely illiquid area, then you can look to you know, lower time frame levels for continuation. But generally, if price is broken market structure and it's hit some liquidity on the weekly, you can expect a pullback on the weekly. Okay, so the point is, you know, once you've got that breaking market structure, you don't want to be rushing into a trade on the lower time frames. Okay, it's hit liquidity on the weekly, you can expect a pullback on the weekly. So you know, I should quickly point out that by the same logic, it's totally fine to take shorts in here. On the lower time frames, you just have to know where you're getting out. Okay, so this is a daily chart. Although on the daily chart, you know, price appears to be trending down here. Okay, you know, quite clearly lower lows, lower highs on the daily. Remember the big picture. We're down at a monthly level within which we've got this break in market structure on the weekly, and price is now pulling back into this fresh or untested liquidity down at the low here. So at this point, I'm expecting this low to hold. Okay. And again, if you're not confident buying that, maybe you're unsure of its substance, or the approach isn't to your liking, or maybe this kind of area is just too wide for your liking, and it's not going to give you a decent risk to reward, then you can wait for the same thing again. Okay, so if we zoom in on this area here, the daily, you can see a break in market structure. Okay, so if we zoom in on that, this is the break in market structure on the daily. You can wait for the same thing on the hourly. Okay, what do you want to see break? There's the last sell side liquidity, high before the low. Once that gets broken, price pulls back through this void into the area from which price broke out of that with good momentum. You know, if you're not comfortable buying that, same thing again. High, low, that's your FTR. Price pulls back into the area from which price left that FTR with good momentum, and carries on up. So I'm just kind of demonstrating how the same dynamic is playing out on all time frames. What you're watching for is break in market structure on the higher time frames, room for you to run a trade, and then you're zooming in on the lower time frames to I guess wait for some confirmation that yeah, sellers are getting weak. These kind of levels are starting to get taken out, and price has found some demand down here. So I feel it's got a little confusing, but it should become clear to you. I'm basically identifying the presence of liquidity on the higher time frames, and then I'm zooming in on the lower time frames to kind of confirm my expectations. To confirm my expectation that yes, buyers are strong, sellers are weak or exhausted, and yes, price is likely going to start turning. That being said, although I'm zooming in to kind of refine my entry here, my expectation for price and the way in which I manage the trade is still very much based on the higher time frames. So I'll just demonstrate. Let's say you've got something like this. Okay. If prices engulf the nearest buy side liquidity on, let's say this is the daily chart, you can see that price has room to run down in here. Let's say that's an illiquid leg in price. price is pulling back to this fresh or untested FTR. Okay. Once it finds sellers somewhere up in this bearish FTR, I'm expecting price to carry on down to the next daily level down in here. Okay, so although I may be on the hourly when price is up in here, A, to look for that confirmation, and B, to refine my entry, I'm not managing the trade on the hourly, okay? Because my expectation is that price is going to start kind of reaching for this daily level. Okay, so when you have price action like this on the higher time frames, and engulf and room for price to run, fresh liquidity, okay, that's what should be kind of guiding your expectations. Okay, this is the premise for the trade, derived from a daily chart. And so even though, you know, it's really useful to zoom in when looking for that confirmation, or to refine your entry, you're not getting out of the nearest hourly level here, because the trade idea, the premise for the trade is derived from the daily chart. So that's what should be guiding your expectations. That's what kind of defines how you manage the trade. So, for example, this is a Euro JPY chart taken a while ago on the weekly, and you can see what I've done is just mark out the lows here on the left, so you can see that when price is trending down, as it is on the right here, okay, we expect these pockets of liquidity which get left behind as price moved up here, we expect those to get broken. And I've also marked them out so that you can see that it's generally a good idea to think of engulfing price action as a kind of a sign that price wants to move to the next area of liquidity on this scale. Okay, so for example, you know, once price has engulfed that low here, it's reasonable to assume that once price finds sellers somewhere up in this bearish FTR, okay, there's a low which got broken, price retraced or consolidate before carrying on down. You know, it's reasonable to assume that once it finds sellers up in there, it's going to carry on down until it hits the next cluster of buy side liquidity on this time frame, which is, you know, down in here. And so the way I would view this is, once price has broken through this low, this is kind of the range you're working in. Okay, the nearest cluster of buy side liquidity, sell side liquidity, sorry, the last bearish FTR, and the next relatively fresh cluster of buyers. Okay, so that's the range you're working in. That's the you know, that's the kind of range which should define your expectations for price. Alex is asking, so if price engulfs and then pulls back hard, you don't care really because you are assuming that will go to the next liquidity, assuming you are in a trade from the top, let's say. I see what you mean. I mean, it totally depends on context here. You know, I wouldn't be trading this because it's too a higher time frame for me. You know, there's no way I'd be sitting through this for however many months that is. But yeah, let's say this was an hourly chart and I was short from up in here somewhere. What I'd be doing is moving my stop down to above the last bearish FTR, the kind of the structure you want to hold for price to remain bearish, fully expecting the pullback. Okay, for some reason, once traders are in a trade, they somehow expect that price is going to run to their target, but of course you've got untested liquidity here. Price is definitely going to pull back. Either you take some profit there and add it back on, or you just sit tight and manage the trade by moving your stop down. I don't know if that's answered your question. Okay, great. Okay, so given the market structure is bearish here, and bearing in mind that the primary place to seek opportunity is on interaction with the extremes, your best bet is to sell as close to possible to where you're wrong in the trade. Okay, which is up in here somewhere. Above that FTR. So as always, what I'd be doing here is zooming in first to refine the level. So if I go down to a daily chart, this is the area we're looking at up in here. You can see that's quite well defined and clearly untested. So I'd have that marked out. And if I wanted confirmation before selling this, what I'd be doing is going down to an even lower time frame, something like the hourly. Okay, when we're up in here, and watching for that break in market structure. And you can see here that this market gives you multiple opportunities to get in short. Perhaps you're selling up in here after having observed that that's the flag limit, which was supporting this structure. It's broken, price has retraced and carried on down. Okay, nice little FTR in there. Or maybe you want to wait for this here to get engulfed, okay, before getting on a retrace to this FTR, specifically the area from which price left with good momentum. So multiple opportunities to get in short on the hourly, but the point is that wherever you get in here, you're expecting weakness. You should be expecting for price to keep breaking down through these hourly levels, because although we're down on this time frame for the purposes of A, confirmation, and B, getting in short with a relatively tight stop, you've got to remember that we've just hit that weekly level, and as a result, it's quite likely that buyers have dried up here and or sellers are strong. Okay, so although you're getting in on the hourly, you're not getting out at the first hourly support. Okay, so although there's still liquidity at these levels, okay, and likely some in there. Okay, our expectation is that these levels will continue to break, that they'll continue to fail, and that price will keep breaking these support levels because it's hit a weekly level, and it's going to be kind of reaching for some more significant buy-side liquidity, which is apparent on the higher time frames. All the way down here somewhere. Is that clear? So this is why I think it's really important to have a flexible approach to time frame. Some people will look at loads of pairs and then simply wait for opportunities to arise on the higher time frames, and this is totally fine. Of course, your trading time frame is often based on, it's a very personal choice reflecting your time constraints and lifestyle, but I think the best traders are less rigid in their approach. Rather than waiting for an entry to trigger on some fixed time frame, they're able to cycle through different time frames to get a more detailed picture of how price is developing, and to proactively look for setups with which they can get in early and try and run the trade. And it's a bit morbid, but there's quite a nice analogy. Last summer, in August, I went to visit my partner's parents in Marvão, which is in the east of Portugal, just over the Spanish border, where they have a real problem with wildfires in the summer, and you could actually see them from where I was staying. So it was actually really scary. These things spread so quickly. But the point is that, just like with price, when the conditions are right, so in this case, it's an area really dense with highly flammable trees. I think it's cork, and extremely high temperatures. Then the people there are vigilant, so they're not waiting until the whole valley's on fire. They're careful with cigarettes and machinery, anything which could generate a spark, basically. And when a fire does break out, they catch it early, or they catch it before it spreads. And it's the same with price. When the conditions are right, it's time to pay attention to the details, because that's how you catch those big swings. That's how you kind of get in before it spreads, as it were. So although I'm deriving my levels and most of my trade ideas from the higher time frames, the quote unquote big picture, I'm also watching on the lower time frames to get a more detailed picture of how price action is developing, and to kind of pinpoint turning points in price as soon as possible. And again, because price is fractal, the same kind of logic applies on all time frames. So it's the last example here. Bitcoin on I think this is an 8-hour chart. And although you can't see it on this chart, there's a big weekly level up in here somewhere. And so again, what I'm doing is just kind of keeping track of the clusters of liquidity which price leaves behind as it moves up. So these liquidity bases. Okay. And having noted that the market is now running thin into a weekly level, one of the things I'm watching for is for these areas of consolidation to start breaking. Okay, so what have we got? Let's mark this out accurately. Okay, price spikes into this level. You can see it consumes it fully here, pushes all the way to the extreme. Carries on down, fully consumes that liquidity there before pulling back, and it's this pullback here which you want to be selling, because price has broken market structure. It's consumed, likely fully consumed, this pocket of liquidity, and so on this time frame, there's room to short on a pullback, room to short down to the next area of fresh or untested liquidity, which is down in this space somewhere. And I hope that makes sense. And price won't always make sense to you, and so a large part of your edge is only engaging with the market when the structure makes sense to you, when it's clear, when there is actually an opportunity there, and there won't always be one. But again, when price is up here, when it pulls back, you've noted that price has fully consumed this liquidity, and that there's likely room to run short down to the next area of buy side liquidity down here. Okay. So when price is up in here, I'm repeating the same process on the lower time frames. So I'll just demonstrate. I think this is an hourly chart. So again, I'm zooming in here and waiting for that break in market structure. There's a low before the high. There's the break. I actually shorted this spike here. But I'll talk a bit more about that in the webinar on false breaks, because what I want to focus on here is the way in which levels on this time frame get kind of washed out. So price has been trending up here for however many days, and so while that's happening, buyers are getting weaker and weaker. It's also just a level at which we know there are likely large or influential participants waiting to sell. Okay, up in that weekly level, some of whom are going to start chasing price down. So the point is that even though price is going to react at levels like this, okay, fresh or untested liquidity there, maybe some down in here, down in here. Even though price will likely react at those levels, you will get a response. My expectation is that even if they don't get engulfed on the first test, price will continue breaking down here. The idea being that price is reaching for that higher time frame liquidity base all the way down below this low somewhere. So that's why you want to be kind of in sync with the flow here, because although you'll get a response at levels like this and like this and like this, there's clearly more value in shorts here. And the same thing again, if you're ever not confident in the way in which price pulls back to these bearish FTRs as it's kind of trending down here on the hourly, you can repeat the same process on an even lower time frame, because as you're well aware now, price is fractal. So what I've done is just zoomed into one of those FTRs here, so that you can see how I would repeat the same process on a lower time frame. So just to demonstrate the same dynamic, basically. The idea being that as price is running up here on the M15, on this time frame, buyers are starting to get weak. Price hits some fresh liquidity up in the hourly FTR, and then it starts breaking down. Okay, breaking down through these relatively low time frame levels. So there's the low before the high. There's your engulf. And so when price pulls back here, that's where you want to be selling. So, um, that's all for today. Have you got any questions about any of that? Alex is asking, so with this trade, you exited at that high time frame, lower level, you held all the way. No, actually, as it happens, I fucked this trade up, and it got out around this low here. So, you know, it was still a nice trade, but I jumped out on price action on the lower time frames here, thinking that it would continue to range as a result of the way in which it traded into this low. But I'll talk a bit more about this in the webinar on false breaks in a couple of weeks. So yeah, that's all for today. I hope it's given you a good idea of how the kind of liquidity dynamics I've been talking about, you know, interact with structure across or between different time frames, as well as some kind of practical ways to structure analysis and manage expectations. Okay, great. And as I say, next week we'll do the trade review, and I'll just make it a kind of general Q&A as well, so that we can kind of consolidate everything we've covered so far. So yeah, send me your questions, send me your trades, and then the week after that we'll get into some more volume related stuff. So we'll look at volume profile and market profile and how you can use those as kind of confluence. But yeah, as I say, in the meantime, it would be great if you could send me your charts, questions, ideas, anything you're unsure about or want my opinion on, especially as it relates to scale and the stuff I've covered today, because I know it can get confusing. And then we'll have lots to talk about on Friday. Okay. So thanks for your time, guys. I hope you all have a good weekend.